Hello traders, it's Saturday, April the 20th. This is John Kicklighter, Chief Strategist for DailyFX.com. Here to give you the FX market wrap-up for this past week and an outlook for what we can expect from the markets going forward. This past week was riddled with volatility and exceptional movements from one-offs and really markets backing up to major technical levels. But we are starting to see a more thematic development, and that is something that can lead us to persistent trends. We need that fundamental theme to give the technical drive, to give the momentum that we have been long waiting for, and to revive those correlations that have, as of late, dissipated. It's dissipated because we don't have that common thread, that common element to align all the markets to the same thing. And I think that same thing will once again come back into view as risk-based trends. So we headed into this past close, and it left us at extremely remarkable levels. All right, so we were looking at something like, here we have the Dow Jones Industrial Average with that nice break to the downside, but that's one way of looking at it, to see a technical break, but you really have to look at it from this perspective. We have to clear with conviction technical support. All right, and I use the S&P 500, as I said multiple times before, as a measure of risk-based trends. You can see here that we still have a very clear head and shoulders pattern for the technical traders, and I would peg this level at 1535 loosely. Now, this is kind of a symbolic level to break on a symbolic index that reflects basic sentiment, basic investor positioning, as well as the confidence that the market has in stimulus. Now, we've talked about this a number of times. When we look at the S&P 500 and we look at the real potential and return, right, based upon benchmark rates, of course there's going to be higher rates of return than the benchmark levels, but it's based upon that foundation. And as you can see here, between the S&P 500 and market yields, or the reward, quote unquote, level of the market, you have a substantial differential. Right? And that allowance for extremely small rates of return is made viable because of the implication of stimulus expectations. Right? Stimulus is filling in the gap and reducing volatility, so people don't think that there is much risk in taking otherwise very low level of return assets and accepting that as a reasonable investment. We have to be reminded that stimulus is a very real factor, but how long can it hold? How long can it prevent the fundamentals of risk reward, which is what you see with this risk reward index, are reconciled with actual positioning, which is what the S&P 500 reflects, as you see here. Risk trends is going to be quite considerable into next week, and it will be an ongoing possibility. I'm not saying that we're going to immediately turn to risk aversion. We have had the probability of risk aversion kicking in for quite some time now, and that possibility has been thwarted each leg of the way, each step we make higher. And that's because there is a very considerable amount of support being offered not only by the Fed, but the Bank of Japan, the European Central Bank, as well as the Bank of England and other central banks around the world. That additional support keeps a level of stability that investors are still putting their money behind, that level of low risk and low return, actually, rate of return kind of combination. But we can see it's not just with the S&P 500. I'm using this as kind of a benchmark. It kind of gives a sense of risk trends, and we can use it as that effigy that will be beaten down when it eventually does fall. But you can see this is not the only benchmark out there. You see something like the dollar index. All right, the dollar index is the exact opposite of the S&P 500. Stimulus from the Fed particularly diminishes the appeal of the US dollar, and furthermore, stimulus as it leads to moral hazard and risk-taking undermines the dollar as well, because the dollar is a safe haven currency. But as you can see, we have actually had a break of this wedge formation. It's a relatively weak wedge, technically speaking. Much more important is this big fib that we have here. In fact, that is a 2.5-year high that we have. We technically closed at a 2.5-year high here, but this is a midpoint of the past decades worth of range. All right, so that is a very substantial technical level, and it's not just something we see in the dollar index, it's also seen in the dollar's major components. So we see the euro dollar here. Nice congestion. All right, looks like a head and shoulders pattern to me with a descending neckline, but I would peg it at the even floor of 130. If there is a concerted move towards risk aversion next week, in other words, if we see the S&P 500 dropping and playing catch up to risk appetite trends, we'll talk about the fundamentals that could potentially accomplish this. But if we do get a risk aversion move, I am actually a big fan of the euro dollar to the downside, breaking 130. Now, another interesting currency pair that has shown very substantial dollar performance is dollar yen. However, in a concerted move towards risk aversion, the dollar yen, as I explained numerous times before, would most likely see a drop off. Why? Because the yen crosses in general, not the dollar yen necessarily, but something like an Aussie yen or a Kiwi yen or a CAD yen. Those kind of yen-based crosses, even the fundamentally troubled currency yen crosses, are built up on the assumption of carry trade. All right, and that yield differential that people seek absolutely reflects the kind of unlikely investment that is made with extremely low levels of yield while people are just simply enjoying the exceptionally low level of volatility. You pick up that volatility and then subsequently the yield, it becomes very much a concern, and we have a unwinding of these pairs which have been driven so abruptly higher in such a short period of time that not only is the yen oversold, but it also is unwinding from the carry perspective. That mass of carry unwind would see the yen advance much more quickly than the dollar. Even though the dollar is a safe haven currency, and it would get a similar kind of bid, and even in an exceptionally threatening environment where you're talking about liquidity problems, you would still see that unwinding of an oversold yen would outpace the new or established position of a dollar safe haven position. So you would see a dollar yen drop to the downside. All right. Now, I like the dollar yen actually as an alternative to that scenario, because I don't want all risk aversion trades. There's plenty of risk aversion trades out there, but what is the best opportunity if risk trends actually do establish a floor here and a continuation? It wouldn't be unlikely. In fact, that's probably the baseline scenario considering what our overall trend is. All right, we have to run by probabilities, but for that scenario, I actually like the possibility of a dollar yen break to above 100. 100 is the 50% retracement, or the midpoint of, once again, a 10-year range. Right? So over the past 10 years, we have ranged between essentially 123.87 and 75.53. Guess what? The exact midpoint is just below 100. Right, which itself is a round figure that has been floated in the media as it's been referred to by the finance minister in Japan, the central bank governor in Japan, and the prime minister in Japan. So there is a lot in that level. So if we break that 100, even if it's a relatively weak risk appetite based move, all right, I don't really like the dollar yen on risk appetite trends itself. I like it in the longer haul as a kind of a rebalancing of fundamentals. But with that break, given how prominent the 100 level is, it would most likely find a very rapid short-term follow-through. All right, it would be a volatile move to the upside. So I do like this as an alternative in a rally above 100. So establishing what are the parameters for, or the scenarios for various outcomes, and the parameters that would actually signify or signal to us that those trades are actually taking place. Now, in terms of risk-based trends, All right, we've been talking about the early signs of risk starting to pick up. We mentioned the volatility index from the S&P 500, and indeed, we were looking at the correlation between these different asset classes, and correlation between different asset classes, which fundamentally should be moving under their own power. Very different fundamental aspects that would define their bearing and their pace, right? But when you have a common theme that aligns all of them, and very few fundamental themes can align all these markets, but sentiment, whether I'm placing my money with risky assets or whether I'm moving it to safe assets, that is one of those themes that is persistent, and it is always going to be dotted with volatility and momentum. So we look for the correlation here, and we can see that the correlation has been pretty decent as of this past week, but the uptick that we've had just through the end of the week was relatively weak, relatively mild. All right, so it doesn't undermine our effort. I also have here the comparison and normalized it to 100 from the beginning of the year. Otherwise, you're going to be seeing very vastly different measures of volatility here. But you can see these are the 4 volatility indexes for the different asset classes. All right, you have gold and FX picking up, but you still have equities below the start of the year, as well as treasury yield volatility below the start of the year. So we have not had the full shift towards risk trends, but you absolutely have the technical levels that suggest, and the fact that you have the S&P 500 lining up to that major potential break. You have the U.S. dollar as a safe haven lining up to that potential major break. UK oil, Brent oil, as a commodity representative lining up to a possible break to the downside. These are all kind of the signals that a bigger move, not just technically, but fundamentally, can spill over to these markets. So what can actually catalyze such a move? Well, we have a pretty active docket in the coming week, referring to my Manic Crisis calendar, which I curate specifically just to look for those events that have a potential of moving underlying risk-based trends, not for an individual country or region, but more so of moving sentiment on a global basis. We are going through the weekend with the G20 meeting and the IMF meetings. We'll see what they have there. But this past session, Friday's statement actually suggested that they weren't going to do and go any further in labeling a currency manipulator of Japan, which I think is quite interesting. But it's to be expected. You have a number of growth readings. You have the Chicago Fed, which is going, the National Activity Index, which will start us off. You have the Chinese manufacturing activity, which we use as a proxy for overall growth. You have the Eurozone PMI, which is also a proxy for growth. But we really get into the heavy stuff when we're talking about economic activity when we get to the UK GDP and we get to the US GDP on Friday. Now, the US GDP has multiple facets to it. It can influence basic risk trends through the expectations of the world's largest economy, whether under or overperforms, but it also speaks to a building discussion about whether the Fed is going to temper its stimulus effort, right, which has a profound influence on risk trends. As you can see, roughly the correlation here between the Fed balance sheet and its actual growth and the S&P 500 has been quite remarkable. Fundamentally speaking, that should make sense because it boosts risk taking. All right. At the same time, actual participation in that risk taking has collapsed, but that exposes the risks that we are actually facing. This has the greatest potential of being a catalyst, but it does occur at the very end of the week. Don't write off the possibility, though, that you can actually get sentiment to move under its own power through brute force and simply see a market-wide move towards risk aversion, because once you start tripping enough stop levels, all right, so think in terms of the gold market. When we started to slip below that very prominent range support, the level of stop interest down here, and subsequently the new short entry orders below here, all right, fed and exacerbated the move to the downside. The same thing can happen on an aggregate or a global basis across all these different markets, considering that you have the dollar so close to a breakout, you have the U.S. equity index is so close to a breakout, the commodities so close to a breakout. If they can all get a similar situation to gold, all right, you can move the markets by brute force. If you just set, it's a highly flammable market, and you set a spark just in the right spot, and it can get moving. So we don't necessarily need these very high-level fundamental catalysts. You can actually get the market moving by itself, but it does take more of a number of very specific outcomes. You have to have everything align at the right time. All the stars have to align for it to be that kind of situation, though we are getting pretty close to that. Some other event risks that I would that I warn you about. We did have this past session the downgrade from the Fitch rating agency of the United Kingdom from AAA to AA plus. All right. This is the second rating agency to downgrade the country, and it's interesting that they actually decided to downgrade the UK well before the market close, which is unlike these rating agencies, whether they do it on purpose or not. They usually do it after the close. But this news actually didn't allow for a meaningful break to the downside on the pound dollar, which I found quite surprising. Now, risk aversion will be a factor for pound dollar absolutely going into next week, but look to see how the London markets react to, because they didn't have an ability to fully react to the downgrade for the country. It also has created some problems with the euro pound, which I thought had a good potential of, once again, the pound has its own fundamental appeal because it has been pushed significantly lower on the assumptions that stimulus would be picked up pretty aggressively as the new Bank of England leadership and future Governor Carney was probably overrun a little bit. However, this is kind of a mitigating factor, the downgrade, and it can complicate the factor. I wouldn't necessarily play a break to the upside. I still like the general view of a euro pound short, but obviously, given the situation now, the event risk as it could play out as we open up next week, make it a little bit more difficult. That is also at least put a temporary buffer or stalled the pound kiwi. Now, this is actually rounding off of a record low. I still think this has great potential, especially if the pound kiwi breaks the upside on a risk aversion move, because while the pound and the kiwi have individual levels of risk, as do any currency, the kiwi is far more sensitive because it is an investment currency. So if we break above this 82.50, 82.75 level, I think that the fact that it does make that break, despite the downgrade, that it would be even more appealing for a run to the upside, potentially add as it gets through 84.25. So this is still an interesting pair. You just have to see the actual follow-through and the fundamentals to key in with. Another interesting individual piece of event risk that, and of course the pound will have Thursday's UK GDP, which is an upcoming, which is a further threat. But I also think that watching the RBNZ rate decision should be an interesting additional factor for the pound kiwi, yes, but also the kiwi dollar. I changed around my technicals a little bit. I lessened the importance of this 85 level. You have to, considering that we cleared it and then we traded around it so much. You have a nice consistent rising trend line here of lows. All right, this is a daily chart. So a potential break to the downside at 84 would be best served by risk aversion, but you can't downplay the importance of the RBNZ rate decision, though they're unlikely to actually change their policy on Tuesday evening, Wednesday morning. It will play into the appeal of the high yield. All right. Now remember, I don't have this for the Kiwi dollar, but you can absolutely see this also in the Kiwi yen. We're talking about the yield that can be had on this. When we look at this objectively, something like a Kiwi yen, we can see that the rates of return are extremely low, extremely low. All right. So it's all you have to do is remind the markets that you're bidding up a historically low level of return on the assumptions that volatility will remain low, that there is no risk in taking this otherwise unflattering trade. But you give a little bit of volatility, whether it be through risk aversion or whether it be through the RB&Z rate decision itself, it can shake up these markets quite dramatically. The Bank of Japan is going to be another show up next week. They're going to be later in the week, actually Friday morning. Now, a lot of people ask me what the time for their release is. They give no actual time for their release. Instead, they have like a rough range of times, usually between 2:30 and 3:30 GMT. There is a specific time for a 3 a.m. GMT release of an outlook report, so they're going to give their essentially growth forecasts. And then you have 6:30 a.m. GMT, where the Governor Kuroda is going to be giving his press conference. So those are time frames that we have, but it's going to be the rate decision itself that's interesting. Now, the Bank of Japan actually at the last policy decision policy meeting made their dramatic changes. They introduced that new stimulus program, the 7 trillion yen per month. That is a big step up. We might get some clarity for what they're going to do going forward, but you're not going to see a major change because they've already put the change in. They have to actually put it into practice. No longer are we just going to be escalating the threats. They have to allow some of their policy to work. And if that's the case, the markets might say, all right, well, we've priced in what is already going to be had. Now is time to see if it really does live up to expectations. And it can very easily play into a buy the rumor, sell the news kind of scenario, as you guys are probably most used to that saying. And that can very well be what we see here. And lo and behold, if that's the case, the yen can find a recovery effort at the same time, and this is purely ideal scenarios, but at the same time that you get a yen retracing its oversold position, if you also got a risk aversion move, all right, it would present an incredible opportunity for the yen crosses. Now, of course, all those fundamental stars have to align for that to play out, but the potential is absolutely there. There are some other pieces of event risk, of course, that you should be following. You can look at the calendar if you're on the email list, but I'll be updating as we go through the week. We also have some CPI data from Australia. We have lending data for the UK. You have some Bank of Canada Carney comments through the week. All of that is going to be notable, but really the focus should remain heavily set towards risk-based trends. Risk trends can have a very, very substantive influence on trade potential. You have a number of setups, including euro dollar and the Aussie dollar potentially breaking at 101.50. Of course, all the yen-based crosses. And even if you do have a alternative scenario, risk continues to hold and advance, then you can actually look for other pairs that can set up nicely with the dollar yen above 100 as a particular standout. But remember the long term and remember the short term. We're here to trade, so trade what's in front of you, and even if you don't think the market makes sense fundamentally speaking, go with what the market is actually telling you. But remember the medium to long term outlook. This is the differential between how the markets are actually positioning for risk, and that's the actual fundamentals for risk. So eventually it will reconcile itself, but we got to play you actually trade what's going on. You don't trade your ideals, you trade the markets. So keep that in mind. And be ready for that medium-term shift. If the markets align themselves to the actual fundamentals, then we have ideal scenarios and great trade setups, but there's also trade setups if we do continue to see this complacency play out. So evaluate your markets, look for your scenarios. There's other setups that would be good for risk on and risk off. You can just run through them and find them yourselves, but the technicals and fundamentals line up very nicely on a number of pairs, and these are absolutely the kind of conditions that are best for trading. So do your analysis over the weekend, and I hope everyone has a fantastic weekend otherwise, and a little bit of break from the market, but be bright-eyed and bushy-tailed when you come back, because these markets can be quite volatile come Monday. Good luck trading out there, guys, and I'll give you an update for the beginning of the week on Monday.